Welcome to Energy Unplugged, the go-to podcast addressing the global energy transition. I'm Hugo Batten, Managing Director of Aurora in APAC. We're delighted today to be joined by Matt Grover. Matt is currently the Director of Energy Markets at Fluence in Australia. Before Fluence, he spent time at EnelX and EnerNOC. His last 13 years have been spent firmly focused on Australia's NEM, National Electricity Market. Today's discussion is going to focus on the deepest of deep weeds in battery dispatch and economics. Matt, welcome to Energy Unplugged. So good you can join us.
Thanks, Hugo. It's a pleasure to be here.
We're also joined today by James Ha, Aurora's Head of APAC Research, who's going to help facilitate the chat today. Welcome, James.
Thanks, Hugo. Good to be back.
Now, Matt, we are going to spend all our time on batteries today, but before we do, I think just to paint the basics of the NEM to set the scene. So for our overseas listeners, can you just map out some of the key features of the NEM, particularly as they pertain to battery economics, low and high price caps, the volatility, the 5-minute settlement, all those types of things?
Sure. The Australian NEM, when we're talking about the NEM, is the east coast of Australia. So it's an energy system that peaks around 35 gigawatts in a market that serves around 180 terawatt hours a year. So size-wise, just to put that in context, the NEM would be a kind of small to medium-sized American ISO. So we're probably a little smaller than Texas and California, a little bigger than New York and New England, and about 2/3 the size of GB. We've got a notoriously emissions-intensive electricity mix, with coal still making up around 50 to 60% of our mix. But renewable energy has been slowly creeping up. We're somewhere around 40% renewable contribution at the moment. The NEM, of course, is an energy-only market. One of its key features, no capacity mechanism or capacity payments available to generators. Everyone has to earn all their revenue back through the energy-only market and through ancillary services. And we are a notoriously volatile market where the energy price can swing between a floor of negative $1,000 and a price cap that's currently set at 17,500 Australian dollars per megawatt hour. So the price can and does swing between those. And it's a real-time market, no day-ahead component to unit commitment. Generators can and do rebid their plans and their intentions through to the market operator right up until gate closure, right until the next 5-minute interval. So it's a very fast, very volatile, very exciting market to own any generator, but especially a battery.
And Matt, just as we're recording this, we've literally this evening seen prices hit that cap of 17,500 in New South Wales. And it looks like they've stayed there for a little over an hour, maybe 2 hours almost. So just a real poignant day, I guess, to be recording an episode about volatility in markets.
It is. It's not theoretical. And I've spent a fair chunk of my evening keeping an eye on the batteries that we're helping trade in that market today. There's been some big revenues earned by several battery projects.
Awesome. I should note we're recording this in mid-May if anyone's kind of going back through NEM price series to try and work that out. So linked to that, and again, to set the scene as we start looking forward in terms of battery economics, grid-scale batteries that have built in the NEM have generated, I think it's fairly safe to say, fairly healthy returns over the last 4 or 5 years. And there's been kind of 4 to 7 of them, depending on when you set the start date, that have done pretty well. Can you just talk our listeners through what has driven those fairly decent returns over the last 4 or 5 years?
Yeah, we could probably start at the beginning of the NEM's journey with big grid scale batteries. So we've had big batteries participating in the market in the NEM for 7 or 8 years now. And for the first 4 or 5 years, there was only a handful of battery projects. The majority of revenues they were earning were coming from ancillary services, which we call FCAS, frequency control ancillary services in the local parlance. And fast forward to today, 7 or 8 years later, we've got upwards of 30 grid scale battery projects. We're somewhere around 4,000 megawatts of battery projects. and represents basically a doubling from just 6 months ago. At the end of 2024, there was just at about 2,000 megawatts. So we've about doubled our capacity in just the last 6 months, and that trend is only set to continue. And battery projects their revenue mix has transitioned a bit over the years to being primarily coming from energy arbitrage at the moment. The FCAS is a less relevant portion of most batteries revenue stacks as that market has saturated a bit, but returns are healthy. Battery returns are heavily regional dependent, which is something we could talk a bit about, where depending where you build your battery is probably the main factor in how much money your battery project will earn. And the NEM is somewhat famous in that being such a volatile energy price that often a significant percentage of a battery's annual revenues come in a very short handful of days or even hours. If you look at the whole battery fleet last year in calendar year 2024, about 11% of the revenue that the battery fleet earned came on a single day in August. So stats like that really show you how important it is for your battery system to show up when it matters.
Yeah, absolutely. So, and you touched on this, but the final bit of scene setting, I suppose, we've kind of talked about the market design, where batteries have made their money. Just in the short to medium term, there are a number of changes happening at a system level. So, I mean, you talked about coal. A lot of those coal plants are coming out and quite quickly. Some of it is economic. Some of it is coal supply, aging plants, all those kind of issues coming to a head. Australia's, I think, world's highest penetration of rooftop solar. So we're building something like 2 to 3 gigawatts of price-insensitive rooftop solar a year, which is creating an enormous duck curve, negative prices in the day, a big steep ramp. A lot of the transmission is delayed and more expensive than we thought 4 or 5 years ago. And then there's quite big issues around gas supply, and particularly kind of getting the gas where it's produced in the north down to the south where it's needed, and a bit colder and a bit more gas dependent. So all of that is coming together, at least Aurora thinks, to create a fairly healthy environment for batteries. But, we're not the only ones that observe that. Batteries have made a ton of money. And so Aurora, and I think we're at the more conservative end, is forecasting something like 10 gigawatts of batteries by the late 2020s. So a lot of drivers, I think, particularly for energy arbitrage, creating what we see as kind of a bimodal price distribution, where the price is very low when renewables are at or close to the margin, very high when gas and other firming technologies are setting the margin at morning and evening peaks. This is all coming together. What's your kind of, I suppose, synthesis on how this will impact battery investment cases over the next 5 to 8 years, say?
Well, I would expect battery investment cases to remain strong. I'd be a bullish battery investor if I were an investor type. All the factors you just described there, I would describe as strong fundamentals for battery storage. There's several things that are driving that view. First amongst them is just the strong price signal we're getting during the middle of the day when the NEM is flush with solar and we're seeing strong negative prices. I'd be surprised if any electricity market in the world had higher incidence of negative prices than the NEM. We have something around 15% of the time on an annual basis, the price is negative if you combine all the NEM's regions in aggregate. And that trend seems to only continue. The market is sending a price signal that is screaming out for more demand when we have ample supply, and particularly in the middle of the day. And batteries are the fastest to market and most efficient resource you can build to respond to that price signal. You're also seeing increasing price spreads over time, certainly looking back at history. And if you look at the forecasts that experts like Aurora are making, most people are tipping the daily energy spread to widen. Of course, for batteries, it's not average energy prices that we're interested in. It's the spread between the lowest and the highest prices in a day. And the FCAS remains a material part of most batteries business cases. If I think back to 7 or 8 years ago, when I was looking at these thin FCAS markets, AIMO doesn't buy very much FCAS, and so it was easy to see those markets saturating, and many forecasters were forecasting that FCAS prices would be effectively zero well before now. But the party has lasted longer than I think anyone thought, certainly me, and FCAS remains a substantial, less substantial than in the past, but still a substantial part of each battery's revenue stack today. And another factor I think that makes me bullish for battery investment cases is just the increasing role that weather and related events are going to play, are playing, and will continue to play into the future on the power system in the NEM. We've got an aging system. It's long and skinny, increasingly impacted by weather, and increasingly hosting a aging thermal generation fleet, which is proving to be increasingly unreliable. And so I think you're going to continue to see weather impact the power system in adverse ways and cause pricing events that will continue to incentivize batteries to get up and get built.
It's a super interesting point, Matt. We actually substantiated a similar finding in one of our recent subscriber group meetings in Australia, where we did exactly that, ran 10 years of weather data through our forecasts to see the impact on spreads, and kind of concluded that in the past we've seen a lot of volatility in Australia from things like gas prices and plant outages, and in the future, like weather alone is a significant enough driver that it could cause spreads comparable to what we've seen in recent years when things have gone seriously wrong in the NEM. So definitely a big upside potential there. Matt, I'm really excited to actually be able to get into the weeds with you today. But I wanted to start with just your professional career to date. So particularly at AMS and now your role at Fluence. Could you tell us a little bit about that?
Yes, I've worked all of my career in wholesale electricity markets and most of those years in the NEM. I started out on the demand side of the market, working for a demand response aggregator, where most of my job was focused on helping large loads curtail to avoid high prices. I later found myself working on the supply side of the market, working for a small startup out of California called AMS, Advanced Microgrid Solutions, that was helping wind and solar farms, generators, rebid in the market dynamically to avoid negative prices, so curtail to avoid negative prices. And now, several years later, I find myself at Fluence, having acquired AMS, working primarily with big grid scale battery projects, helping them chase opportunities on both the supply and the demand side. So it kind of feels like my whole career has been building to this point, and it's been a lot of curtailment over the years, and it's been good fun.
And how did that software that you were building at AMS translate into what Fluence now offers to its clients?
So if your listeners know Fluence, they probably know Fluence as a prominent supplier of battery storage systems. So Fluence manufactures, builds, and helps operate grid scale battery storage systems. We've done something like 38 or so gigawatt hours of energy storage system deployments around the world. But that's not my part of Fluence. I work for the digital division of Fluence, where we focus most of our energy on a bidding software product we call Mosaic. It is a algorithmic bid optimization system for clean energy assets operating in several wholesale markets around the world, including the NEM. And it seeks to help generators and battery projects form their trading strategies and decide what prices to offer into the wholesale market to generate at the right times if you're a wind or solar farm, to avoid generating at the wrong times, and if you're a battery asset, to help you correctly calculate your various constraints and opportunity costs to decide when to charge and when to discharge and when to sell ancillary services.
And how widely used is it in the NEM?
We've been here in the NEM since 2019, so something like going on 6 years now. We started out mostly working with wind and solar farms in the early days. The NEM is a unique market in that it's not a straightforward proposition for how a wind or solar farm actually bids into the market. They face several dynamic trade-offs they need to manage, and you actually, to maximize revenue and your return on your investment in your wind or solar farm, you actually need to bid dynamically into the NEM. And we're working with a substantial proportion of the wind and solar fleet in the NEM. They're using our Mosaic tool to define their trading strategy and then execute it autonomously. So It's an algorithmic driven price forecasting, optimization, and rebidding decision-making engine. And in more recent years, as more and more battery projects have become built, we've started working with a substantial portion of the big grid scale battery fleet. Today, we're helping about 18 operational grid scale projects define their trading strategies and operate them in the market. We see ourselves mostly as a trading tool for our customers to use to trade their own assets however they want. We build tools to empower our customers to trade their assets however they see fit.
And just on the sort of benefit side versus the cost side, maybe just to put some numbers around the question, how big of a uplift do you think there is from clients who are using this sort of algorithmic software that helps inform their bids versus how much of the overall cost side does it add to procure software like this?
It's a good question, and you use the word uplift, which is an interesting word in my part of the industry. We used to talk a lot about uplift in the wind or solar context back when we were needing to convince wind and solar farms that they need to do this. Several years ago, we were one of the first companies out there trying to convince wind or solar farms that they can't just leave a static price in the market all the time. You're losing money. And so we used to try fairly hard to calculate and demonstrate how much uplift we could deliver relative to leaving a static bid in place. And for a wind or solar farm in the wrong part of the grid, these things are highly geographic specific. It could be upwards of 10 or even 20% of revenue a year. We could increase by bidding dynamically. Fast forward to today, 6 years later, it's just become for wind and solar farms, it's become an accepted truth that you needed an automated bidding system to succeed in the NEM. And the idea of uplift against a do-nothing strategy of leaving a static bid in place has become antiquated and irrelevant because it's just become accepted that you wouldn't ever do that. And for a battery in the NEM, it is altogether different. It's basically impossible, and I don't think this is a controversial thing to say, basically impossible to bid a battery in the NEM without some kind of automated tool to help you do it. If you tried to do it manually using the same approaches that a legacy generator like a peaking gas unit might have used back in the day, or with a spreadsheet, you just couldn't do it. There's too much information moving too fast, and in order to forecast prices correctly with the latest and best information and manage your forward plan, your state of energy compliantly, and ensure that you're putting bids into the market from your use limited battery that you can physically back and physically honor from a compliance perspective would just be too hard. So almost everyone is using some form of automation, and yeah, we're proud to be one of the most widely adopted tools helping market participants do that.
I mean, it sounds especially important somewhere like the NEM, where, as you've mentioned, it's a 5-minute market. Participants are changing their bids. There's virtually no gate closure, so the price outlook from interval to interval can change dramatically over the course of what is a relatively short span of time. Let's double click on batteries then, because over the last 6 to 12 months in Australia, it feels like there's been a bit of a renewed focus on battery optimization, particularly with the amount of batteries coming online, and a lot more interest and attention given towards things like performance trackers or leaderboards. So a few questions on this topic, and to set the scene, might be helpful if you could describe for our listeners the types of benchmarks that are out there for analyzing battery revenues, benchmarks against capacity, benchmarks versus duration, and where you think these benchmarks are helpful or unhelpful.
Not to jump in, Matt, but I did see an amusing LinkedIn post that said there were more battery leaderboards in Germany than there were operational batteries. And the NEM has more operational batteries, but I think we might still be getting close to that world.
No, that's great. Well, it's an exciting thing. This is a good trend. This means that investors are paying attention and need information about how to make informed decisions. And companies like Aurora, play a very important role in that ecosystem in helping transparently share what's happening in each market and what opportunities are on offer. And so I'm glad that consultants like Aurora are helping play that role and keeping markets liquid and investors informed. But as battery performance benchmarks and leaderboards have proliferated, it is really important that consumers of those resources and investors in particular have an awareness of what metrics they're looking at and what some of the nuances and pros and cons of any given metric can actually tell you and what they can't tell you, because it's easy to draw incorrect conclusions from a battery benchmark. So the two most common ones I see floating around, and Aurora does a very good version of these, are a metric where you take all the batteries in a market and take their total revenue they earned divided by their nameplate megawatts that installed to show a nice, kind of normalized revenue per megawatt metric, which is one way to do it. But it's important to know what that metric's good at and what it's not. Firstly, any metric like that where you're using megawatts as your denominator will automatically advantage a long duration battery over a short duration battery. So anytime you're comparing batteries at different durations on a metric like that, you've got an inherent apples and oranges problem that you need some way to control for. And that metric will also always reward overcycling. So any battery that's chosen to flog itself in the market and chase every little opportunity will look great, regardless of whether or not that's a sane or prudent long-term strategy or long-term use of your asset. Those metrics, of course, ignore any realities between nameplate capacity and actual operational capacity. Several of the batteries in the market don't trade quite at their full capacity all the time. And it also ignores the impact of local price adjustments and the impact of grid constraints in the NEM, which we could probably talk more about.
Yeah, I am keen to turn to a couple of these in a minute, but just to pick up on the comparisons within a market, I think the first battery leaderboard that Aurora published for Australia, you quite rightly let us know that we needed to group the batteries by market region, especially in Australia, where there are such different pricing dynamics between each of the mainland states. So thank you for that feedback. And obviously, grouping by state, grouping by duration, all very important for making those apples to apples comparisons, or at least attempting to make something more like an apples to apples comparison.
And any battery benchmark metric that you're seeing floating around on a chart is essentially a all-in, wrap-up, all-inclusive metric of all aspects of that battery's situation. So any dollars per megawatt or dollars per megawatt hour metric is reflective of several things. It's the region that battery's in, how that battery is being operated, how the battery is performing physically, how its physical kit is performing, what the objectives of the market participant trading the battery are, how good the bidding software is behind that battery. That metric is a wrap-up of all those factors all in one. So it's important not that consumers of leaderboards and benchmark charts are just aware that it's very difficult to draw any one firm conclusion from a leaderboard chart. You can't look at where a battery shows up on a leaderboard chart and say, oh, that battery must have the best bidding system, or oh, that battery must have the best battery system supplier. Like, literally not a valid inference to draw, valid takeaway to draw from a chart like that. But there is one very obvious and helpful conclusion that in the NEM, benchmarking leaderboards can play for investors, which is just as you described, James. The leaderboards are very helpful at discerning the relative magnitude of the opportunities between different NEM regions. So NEM has 5 different pricing regions. And if you group batteries within each region together as a region, as Aurora quite helpfully does in its version of this chart, you can see some orders of magnitude differences between the revenues that batteries are capturing in different parts of the power system. And if you look even more closely, you can maybe even notice some intra-regional dynamics and parts within a region that are not performing, not having as high earning potential as other regions, places within that same region. So that's one conclusion that I think, one role that I think those charts can play in a very useful way for investors, is helping them decide where they should build their battery project, and more relevantly, maybe where they should not.
Right. And we will definitely talk about grid constraints, but just before we do, the other metric that gets thrown around quite a bit is percent of perfect, which is meant to explain how well did a battery perform compared to a perfectly operating battery. But even defining what is perfect is kind of complicated, right? And it depends on, what BESS duration we're talking about, what time frame. Are we perfect over a day, perfect over a week, perfect over the lifetime? What markets are we perfect in, just wholesale or also FCAS? But perhaps you could take us into the weeds there, Matt, on some of those real world constraints, like you mentioned, grid, that lead battery behavior to look not quite like what a theoretically perfect asset might be doing.
Yes, percentage perfect is a very interesting concept and a very, very complicated and tricky one at the same time. So a bit of history, I suppose. In the early days of the NEM, when some of the first battery bidding systems were being stood up, including our Mosaic system back in the early days, some clever engineers at AMS and at other companies were thinking of a way to quantify how well their new automated bidding algorithms were performing. And they came up with a method where they said, well, we've got this powerful optimization that can find the highest revenue solution for any given set of constraints. And the main challenge we face is having imperfect price forecast when we run that optimization. That's one of the main ways we lose revenue. So they tried to work out a way to calculate, well, how much money would my battery have earned if I hadn't been trading with a price forecast and I instead was optimizing my battery using the same algorithm, but with a perfect view of prices. And so the way we've developed that capability at AMS and now at Fluence is we can replay a trading day with our battery using the same settings and the same physical constraints, but instead of loading a price forecast into it, we load in the actual prices, and that lets us build up a counterfactual of theoretically how much money could the battery have earned if it had perfect information. And we probably in the early days somewhat naively thought that was a very clever metric and going to be very useful. And as we've become more experienced doing this and talking about percentage perfect and trying to leverage it in an operational sense and glean insights from it, we've realized that it's much, much more complicated and a tricky metric to work with. And it's a metric like benchmarking metrics where if you aren't aware of its strengths and weaknesses, it's very easy to draw the wrong conclusions. And so it's very important to understand what question you're trying to answer and whether the counterfactual you've built up lets you answer that question in a useful way or not.
Sounds like you're putting your hand up there, Matt, as someone who's partly responsible for us spending so much time discussing this metric now. I recall a conversation we had a little while ago on one particular day, in the NEM, where extreme pricing was observed, and we noticed that not all batteries in the region where the extreme price happened actually traded. I believe this was in Victoria when a major transmission line went down, and straight away the question is, why did some batteries miss this price spike? Others saw it, or maybe took it. But the reality is no one could have seen this type of event happen. And this was kind of one of the introductions or one of the ways in which we at Aurora discovered we need to go much, much deeper into each trading interval to really understand what's driving market outcomes. I think in this case, it came down to constraints and the way that AEMO manages the network. Would you be able to speak a little bit to the sorts of real world challenges here that affect battery dispatch and that lead real batteries to kind of diverge from this perfect behavior?
So because all batteries are dispatched based on their local price at their local connection point, batteries in different parts of a same region can face very different earning opportunities. And there are times when a battery's generation can get constrained off when the price is high, or your battery's load can get constrained on when the price is high, which is bad. It is possible in the NEM that a battery project, if it doesn't structure its bids quite correctly and it's located in the inopportune part of the power system, that AEMO will attempt to dispatch a battery's load on when the price of power is high. And AEMO can force you to do that if you're not very careful and thoughtful with how you structure your bids. So the bidding process is very important here. And because the power system is dispatched with consideration of these physical realities of transmission and how much can flow through, having your battery located on the right side of a transmission constraint is actually very important. New South Wales is probably the best example of this. So if you look at the year to date, 2025 in New South Wales. There's several battery projects stretched across a large geographic area in New South Wales. And so far, year to date, there's been about 2 hours of prices above $5,000, right? So 24 5-minute intervals above $5,000. If you had a battery in Sydney and eastern New South Wales, you would have the opportunity to dispatch your battery into all 24 of those intervals, 100% of them. The batteries that are located in western New South Wales, out by Darlington Point, have only been offered the opportunity to dispatch their generation into about 80% of those prices, about 80% of those 24 intervals. And if you're unlucky enough to own a battery in Canberra, those battery owners in Canberra have only been able to dispatch their battery into about 20% of those prices so far. So there's batteries all in the same region, facing the same settlement price, but actually being denied access to the same settlement prices based on their physical location in the power system and the way AEMO dispatches assets based on their local prices.
Super interesting. We are getting asked more and more by clients as well to undertake network studies and congestion studies for battery assets. That used to just be a requirement for wind and solar. Everybody was worried about their loss factor and the risk of curtailment. But now even battery developers are increasingly asking us to analyze, the risk of constraints, which is obviously different for renewables. If you're curtailed off, you lose that volume. For batteries, you don't necessarily lose the volume, but you do have to dispatch at a time where the price might not be quite as good as it was. So definitely a growing area of focus for us as well. Awesome. Matt, we've covered a ton of ground there on understanding metrics like percent of perfect and the value of leaderboards. I want to turn to a slightly different topic now, which is just what are you seeing in the offtake space for batteries in the NEM, and what's kind of the most interesting contractual arrangements that new assets coming to market are looking to use to kind of hedge their risk in this market?
Probably the newest and most interesting contract we're seeing a lot of is what's become known as a virtual battery contract or a virtual offtake, virtual toll. Supposed to use the full set of nomenclature you might hear out in the market. And these are contracts between a battery operator, not necessarily the owner, but the operator, the market participant operating the battery in the market, and an offtaker that are purely financial contracts where the offtaker is given the ability to dispatch a portion of that battery virtually. They can submit nominations to the battery operator indicating when they would like to charge or discharge the battery, and the battery operator will pay the offtaker for the energy transacted at the price at the time, at the quantity that was nominated. But it's entirely up to the operator whether they choose to physically dispatch their physical battery to match those nominations or not. And so you end up in battery operators have an interesting new problem to solve under these contracts where they have to decide if they want to physically back the nominations submitted by their offtaker, or if they're happy to take a different view and manage their battery state of energy in a different way in accordance with their own risk management preferences or their own merchant views of the opportunities ahead. So these contracts are very interesting in that they are easy to strike and sign up because they are inherently financial in nature, and all it takes is terms and a signature on a piece of paper, and you've got a virtual battery contract. And they are seemingly helping add financial certainty to the market there for off-takers that are, don't have the resources to develop battery assets and become a market participant and be a trader in the market and all the obligations and overheads that come along with that. They can still get exposure to the spot price. So you see commodities trading houses and types of businesses like those becoming off-takers on virtual battery contracts. And those tolling payments that off-takers are willing to pay are welcome certain revenue streams for battery project developers and battery operators. And so we're hearing about a lot of these contracts that are getting struck and a lot of new players getting involved, and a lot of these contracts helping projects find that elusive revenue stability and revenue certainty that is so difficult to find in an energy-only market. So it's a very exciting space, and we're going to be helping several market participants manage these contracts and optimize them through the bidding process in the years ahead.
And it's super interesting. I mean, I do think, and maybe it's a function of the structure of Australia's market where you do have this extreme volatility, but Australia does seem to be at the kind of bleeding edge of contract design and, as you say, converting very volatile merchant prices into more stable revenue streams. So I think about that on the private sector side, where you're seeing innovations around, as you say, virtual tolls and super peak and intraday spread contracts. But also on the public side, like I do think the Commonwealth Investment Scheme and the New South Wales LTESA contracts are kind of relatively innovative and a clear move away from the European fixed price, CFD, negative price protection. They seem to be trying to balance risk with more nuance between government and the private sector. And even the Nelson Review, and for our listeners, this is a major overhaul of wholesale market design that's happening here in Australia, is talking about some quite interesting contract designs, but for years, like the latter half of an asset's life. So the asset, it's kind of on the asset to kind of come up with some contracts for the first half, and they'll help manage risk in the back half. So there's just a lot happening in Australia in that space. There's not really a question there. It's more kind of fairly tedious monologue, but it does seem to be one of the areas that Australia's at the bleeding edge of.
Absolutely, and I suspect that trend is born out of the energy-only nature of the NEM, where it's just so hard to find revenue certainty, and banks need revenue certainty, and projects need revenue certainty to reach financial close and go ahead. And so you've got participants, really innovating and finding clever and creative ways to strike financial contracts to underpin their business cases.
Awesome. Very conscious of your time, Matt. So let's finish with a couple of rapid fire questions that at least I always try and end on. What's one hypothesis or view that you have on the energy transition that you think is at odds with the general consensus out there?
One thing that I think is underappreciated in the energy transition that Australia is having is just the role that the demand side can and will play. The demand side's never been sexy, and it remains unsexy. But the role that energy efficiency and demand response, both in the traditional sense and in the emerging sense of consumer energy resources being fairly flexible and fairly controllable, and electric vehicle charging and eventual electric vehicle bidirectional charging be quite flexible and controllable, I think is underappreciated and potentially undermodeled by consultants and possibly even by AEMO. And I think getting the energy transition right is going to require policymakers and regulators in the NEM to keep an eye on the demand side and not forget about it, and to find new and creative ways to harness all this new and controllable capacity that's going to come into the power system.
No, I completely agree, Matt. There have been a couple of good academic papers that have come out recently talking about price formation in a world of like deep decarbonization, no thermal, and just the role that demand plays in price formation more than anything else. Awesome. Final question. Who do you read or listen to in the energy space that you think is always good, thought-provoking, and relevant to your work in the private sector?
Well, I'm probably listening to the same podcast that most people in the industry are listening to, so I've got a slightly different take on your question. I've got a book recommendation to offer to the Aurora audience. Recently visiting my in-laws in South Africa, I got handed a book by a guy called Andre de Ruyter called Truth to Power, which he was the CEO of Eskom, the state-owned power system operator and generation system operator in South Africa. And it is a fascinating book I would recommend to anyone. Partly it reads like a spy thriller in some ways. He's dealing with criminal gangs and had an attempt on his life at one point and eventually had to flee the country. But there's just enough power system nerdery in there and market design nerdery to make it relevant and interesting. And it's a very interesting tale that helps put some of the NEM's challenges in greater perspective. So highly entertaining reading, would recommend.
Matt, that sounds terrific. I've added it to my Goodreads list. Let's end it there. Thank you so much for your time today. We've covered an enormous amount of battery nerdery in, I think, 45 or 50 minutes. We're incredibly appreciative for your time. All the best, and thanks again.
Thanks, Aurora team. It's a pleasure to be here. Thanks for the invite.
And James, thank you as well.
No worries. Thanks, Hugo.
That was Matt Grover, Director of Energy Markets at Fluence in Australia, talking to Hugo Batten, Managing Director of Aurora in APAC, and James Haar, Aurora's Head of APAC Research. Thanks for listening to Energy Unplugged. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to follow the podcast via whatever platform you use.